But Jonathan, you ask, isn't free always better? I don't know, is free better than not free? If I don't pay, then who pays? Hi everyone and welcome back to the channel. I'm Jonathan. I bring you the market news in the context of believability so you can save time, you can trade and invest your way, and you can make money. In today's video, I'll be looking at payment for order flow, specifically the top 5 benefits for retail investors. Payment for order flow is a system in which brokers offload their responsibilities to third parties that are sometimes called wholesale. In exchange for filling the orders, these third parties, these wholesalers, are paid a fee from the brokerage. Sorry, that is not right at all. In exchange for offloading these orders to the third parties pay the broker. Yeah, that makes more sense. Taking a look at some of the dominant parties in this space, we find names like Citadel and KCG. Ken Griffith is a name that comes up when we talk about Citadel Securities. These wholesalers, these market makers, fill roughly 1 out of every 5 orders in the US. These companies make sure that the orders from retail investors are handed off from the brokerage to the wholesalers. The wholesalers then go out to exchanges and fill the orders, coming back and bringing the securities back to the broker, who then holds them for the retail investor. The brokers and the wholesalers argue that this is a win for retail investors, for you and me, because they have better markets to trade in. Retail investors have never been able to trade more cheaply or more efficiently. The counter argument is that these payments from the third parties to the brokers constitute kickbacks, and therefore they're a bit suspect. There have been quite a few investigations or attempts at investigations over the last few years, and there have also been some recent rule changes. Even after these rules changes, we can see there's a laundry list of brokers who utilize payment for order flow. Robinhood is one, but there are others. E-Trade, Ally, Webull, TradeStation, Vanguard, Charles Schwab, TD Ameritrade. Interactive Brokers does not utilize payment for order flow when customers are using pro accounts, meaning paying commission, but they do use payment for order flow in other situations. Merrill Edge and Fidelity Investments do not utilize payment for order flow. Payment for order flow was made popular, or at least helped to be realized, because of Bernie Madoff. The rules say retail investors must be able to find information related to payment for order flow on their retail brokerage's website. Now let's jump into the 5 benefits retail investors can expect to experience. The first benefit is higher liquidity. The number of shares traded per day is just higher. This is because there are market makers who are always active. It is their job to be active, and they have an incentive to be active because they make money on every single trade. Therefore, they want to be making a lot of trades. We can visualize higher liquidity if we look at a stock like Apple, which trades in the millions or tens of millions of shares, or if we take a look at a stock like Build-A-Bear, which trades somewhere around 100,000 shares per day. These large differences affect traders' ability to get in and out of transactions, in and out of trades and investments. They can make a difference in how much the profit or loss is realized. The second benefit for retail investors is tighter bid-ask spreads. When shares or options are bought or sold, the investor must pay the difference in the bid-ask spread. As bid-ask spreads are large, investors lose money on each transaction. If bid-ask spreads are small, investors lose less money. Investors and traders always lose money on the bid-ask spread. There's no way around that. But the smaller the bid-ask spread is, the less money is lost. Market makers literally have the job to make the bid-ask spreads as small as possible. The third benefit for retail traders is risk reduction. It means that retail traders can get in and out. They don't have to wait. They don't have to wait for the market to become active again. They don't have to wait for things to look better. The reason why risk is reduced is because there's always a market. There's always this liquidity and relatively close bid-ask spread. If you look at some overnight futures markets, you can see that there are times when there's almost no volume. In this situation, it is very, very, very expensive to get out of a trade, and therefore the risk when entering a trade is higher. The fourth benefit is lower barriers to trading and investing. This benefit is brought about by the fact that retail brokerages are now able to carry out their services and offer services without charging so high fees. Examples are Robinhood, Webull. You may not like them, but they are out there. They're not charging their customers a lot of money, and they're allowing their customers to enter the market, to invest and trade. Market makers make this happen because market makers pay the brokerages for order flow and therefore brokerages don't have to charge fees, monthly fees or commissions to their customers. The fifth advantage for retail investors and traders is commission-free trading, low commission trading, whichever one your brokerage offers. I alluded to this at the beginning of the video, but let's take a look at really how much commissions have come down in the last 5, 10, 15, 20 years. Let's see where they are today at practically zero. Going as far back as 1980, we can see here that commissions were up over $100 per share. We can see here a direct inverse relationship between the price of commissions per share and the volume traded. We can also see that commissions have just fallen off the cliff. As a retail investor, when I have to pay a lower commission, that means I get to keep more of my profit or reduce my loss if it's a bad trade in our investment. What this means practically is that I can either enter more trades or I can enter the trades when I want to and not just when circumstances are at the very best. In the end, it gives retail investors the option to do what they want, when they want to do it. Let's bring this list of 5 benefits to the retail investors together. Do I believe that these 5 benefits for retail investors are worth it and really make a difference? The short answer is yes. I do believe that these things make a difference. I believe that Robinhood has been given a bad name on this. I do believe other brokerages are being unduly targeted. And the main reason why I believe this is because of the limit order. As a retail investor, I never have to pay more than I want to or sell for less than I want to. And therefore, the bid-ask spread is irrelevant. The payment for order flow is irrelevant. What is relevant is I don't have to pay commission. To answer the question from the start of the video, free is better than not free, and I'm able to start up new brokerage accounts or use a brokerage account with a smaller account value, meaning more people can participate, more people can start investing, start trading, more people can learn. One important thing about investing and trading is it's a decision-making process, and decision-making takes practice. Some people naturally make all the right decisions, or so it seems, but in reality, the people who make the best decisions over time generally have the practice the most and learn from their mistakes and also from other people's mistakes. Thank you for joining me today. If you've not yet subscribed to my channel, please consider subscribing now and leave a like rating down below if you are enjoying the content. Jonathan out.